Yeah, another common question we have in a lot of our meetings is how much risk should I be taking on? What should my allocation be? How much stock, how much bond? You know, and it could be a very personal question or it could be a very pure number question.
Yeah, this is a this is another one that get asked at the parties or the street party or whatever it is. How much stock should I have? Long term, and people look to us. It's kind of fascinating as for well, you just tell me what I need, and actually, we have to kind of turn that back around because really we have to look at you or the client and say, okay, how much risk can you afford?
Hmm.
And so that's where it kind of starts. There's two parts of risk as far as I'm concerned. Number one is the amount of risk that you have to take to accomplish your goals. We can figure that out in the financial plan. We can figure out pretty much exactly, or at least within a range, of how much money you should have in the stock market to make sure that your probability of success when we run that Monte Carlo simulation is adequate. And but nobody really pays that much attention to their financial plan when the market is caving in like it did in 2008. And so it's much more important to identify the risk level that you can kind of afford emotionally. And that's different for everybody. Again, that's a little bit like a fingerprint. And it's a lot of people think it's age related. It is a little, but not completely. I've had some older clients that are super aggressive and some younger clients that are super conservative. So it has a lot more to do with just outlook, situational outlook, those types of things. It doesn't even have that much to do with how much money you have, because I've heard that a lot too. Oh, well, those people must have a lot of money. That's why they're taking that risk. That's not true. I've seen all kinds of asset levels and different, strategies for sometimes people with a lot of money have a lot to lose. They can be
Hmm.
more conservative, than somebody with smaller amounts. So it's much more. It's just a personal thing. There's nothing wrong with the way you feel about risk. That's
Yeah.
the right way to feel. It's the way you feel.
It's a much more emotional reaction. When I lose $10 versus if you give me $10, we have very different reactions.
Yeah.
And like losing $10 is way worse than that gain that you got from getting that $10.
Yeah,
And so we're a
exactly.
lot more loss averse. And
Yep.
so that's why we focus more on the losses when we talk about risk.
That's right, and that's exactly it. And you'll see that in the charts. If you look at the charts, they kind of have a sloping, slowly sloping upward motion, and then they kind of sometimes have a cliff on those downsides.
Hmm.
And that is because those losses are more painful. It brings in fear. Fear is a strong emotion. And so we want to focus on that fear up front, try to get you to feel a little bit of that fear and identify some of that so that you can kind of see what happens. So one of the ways we do that, and I'll share this with you, is just to take a look at historical returns for different mixtures and really kind of focus on that worst year, for
Hmm.
example, and get you to internalize that and imagine what that would be like, right? So this is from Vanguard. They have some great stuff, and this is really a great one here. This is going back 1926 to 2020. I mean, it's a really great long term, and it's 20% stock, 80% bond, right? So
Hmm.
kind of conservative. And the average return you can see is 7.2, not bad. Again, long term. Best year is 40.7% in 1982. Worst year is negative 10.1%.
Yep.
And it had 16 losses out of the 95 years that they're covering. That's not too bad,
Yep.
actually. And so what we'd be talking about here, though, predominantly, is that kind of worst year time frame. You got to be a little careful here because 1931 was the Great Depression. Maybe we don't have another Great Depression in your lifetime. You got to be careful to be too conservative, but it's still informative to me. So I would take your basically, the amount of money that you have invested and say, okay, let's talk about this in dollars. So
Hmm.
you got $100,000. All right, good. So 10%. How would you feel if that 100,000 was now worth 90,000? Would that make you panic or not? Or let's say you have $1 million, it drops 10%. What would you feel if that was worth 900,000? You got a
Yeah.
statement.
It's a lot harder when you see like a year's worth of salary kind of just disappear versus a couple weeks of salary.
Right.
And that's like you have that gut feel, that emotional reaction is so much stronger.
Yeah, exactly right. And so, the key is being able to kind of find a portfolio that you're comfortable with. And one of my other pieces that I always try to bring through to the clients is that sometimes it's a lot easier to deal with risk when you know what can happen.
Mm-hmm.
So, for example, with this portfolio, if you thought the worst that could happen was a 5% drop, and all of a sudden it drops 10%, you're going to be pretty concerned because that's exceeding your expectations, right? And so setting those expectations, and this is an analogy I've used lots of times. I still love it. You're walking down a dark street. There's this tall hedge in front of you, right? And somebody jumps out from behind that hedge.
Mm-hmm.
You're scared. You're going to react. Your adrenaline's going and what have you. That's a little bit like not knowing what's going to happen to your portfolio, and then all of a sudden it drops and you're panicking.
Mm-hmm.
Versus walking down that same dark street, got that same hedge, except one difference. You know that there's a person behind that hedge that's going to jump out at you. Not nearly as scary.
Yeah.
Right? So when you know how much it could drop. So we use a thing called Riskalyze, a company that comes in and analyzes our portfolios from the outside. They send our clients every quarter a report that shows, how much that portfolio theoretically could drop in, say, the Great Recession that we just had. And so there's, we're hoping that people are able to internalize quarter after quarter after quarter how much risk they're taking. And again, that's just pointing out the guy behind the hedge over and over again, so that when it does happen, so this year the S&P 500 is down from its highest to its lowest point, 14.6%, which is kind of a normal downturn, but hopefully it helps. Say, okay, well, this is what happens. If I want that 7.2% average return, I got to go through these downturns, right? And so just to give you some examples here, so here's a 40% portfolio, right? Higher return average, 8.2. I know it doesn't seem like much, 1%, but it's amazing what 1% does over a long period of time.
It can really grow.
It can. And so this has a worst year. Again, 1931, bad year, obviously, down 18.4%. Okay? So what's that mean? What's the dollar amount to you? How does that work for you? How does that feel, for you as far as that goes? 60%, which is our most common portfolio. Again, 26.6% downturn. How does that feel? Most of the times it's up. 22 times down out of 95, so that's good. That helps. But again, higher rate of return, 9.1 here. And then, of course, 80%. Now you get into a negative 35% downturn. And then, of course, the big one, 100% stock, right? Negative 43. Again, 1931.
Yep.
Horrid year for the stock market, but
you're starting to see though, having more stock, you have more years with a loss, and so you can kind of see there's more volatility, and so you get in exchange for that volatility and risk that you take on, you get a little bit more return, but you have to be able to stomach that risk. And some ways to stomach that risk is, do I have enough cash? Do I have a strong financial plan that I can stick to? And you have to also remember, like, you gotta sometimes take a breath and not let your emotional side get to it, and kind of take a little step back, because you're in the long haul.
Yeah.
You don't need, sometimes if you're at 45 and it's your retirement portfolio and you don't need a 65, should I be really freaking out that I lost a lot of money here, but I can't access that money? I don't need this money now.
Yeah, that's right. So how long until you need the money factors in. You're right, though. Some people kind of talk themselves into a frenzy when they look at the reality. Sometimes that helps, right? The other thing we talked about that really helps is the structure of your overall portfolio. How much incomes do you have coming in that aren't affected by the stock market? And then really, how much money do you have set aside? If you're going to be in the 60% portfolio and it's going to drop 26%, theoretically in 1931, it'd be awful nice to have a fair amount of money sitting there in, money markets and short-term bonds and different, vehicles that are very safe, so that you could live off of that for a while and let your portfolio recover and come back. Sure, in my opinion, that would help me tremendously to kind of deal with those downturns, is to have that structure. It's when you're really pushing the envelope and everything's out there and, you're needing every ounce of return, and then it disappears. that's when things can get really kind of scary. But having that luxurious setup throughout your retirement, I think, is important. And to me, having good emergency monies established allows people to maybe take a little bit more risk than they would have. So maybe they're in the 60% portfolio instead of 40, which creates a higher rate of return by having that money sitting in accounts that aren't doing that well.
Yeah.
And I get that a lot. Oh, I'm not making any money on the bank. I'm not making it's not important because that bank money is there to help you have more calmness about those stock market returns, which can be volatile. So really fascinating subject as a whole. I really find that interesting. And so in a nutshell here, essentially, how much risk you could take has to do with what you need to take, but more importantly, what risk you can afford to take. And we have found that really kind of identifying historical downturns, putting that into dollar amounts for the clients, and being able to take a look at that and say, hey, here's what you would lose theoretically in these different situations. How comfortable are you with that? And we just kind of find that middle ground that works. But it's an ongoing thing, right? Because, somebody who has a great job, lots of cash flow, all of a sudden doesn't have a job, that can change their feeling of risk, right? And so maybe you adjust a portfolio for that, or different situations that might happen in retirement. There are scenarios that happen that make people shift their risk because of what just kind of a shock to the financial system, so to speak. So there are some things that happen. So it's not a constant. It does change, but it is important. We feel like this is a super important area. If you're in the wrong portfolio, right? If you're in a more aggressive portfolio than you can handle, you're going to lose money.
Yeah.
That's what's going to happen because eventually the market's going to fall and it's going to exceed your tolerance. And that's when you're going to panic and you're going to sell at that low point. And you shouldn't have been in that in the first place, is what happens in hindsight. So trying to figure out what that is. And it doesn't help us as advisors either to have you in the wrong place. I don't really care if you're 20% or 100%. I don't care. I want to make sure you're comfortable with that as far as that goes.